Many banks and financial institutions continue to set their net zero targets, which almost entirely relate to their financed emissions. A bank's financed emissions are the real-world greenhouse gas emissions of their clients or investments. To achieve their net zero targets, however, banks need to work with their clients to understand their transition plans and ensure that the companies meet the targets that they have set. But research suggests that only 44% of companies with net zero targets actually have a published transition plan, putting the attainment of their targets at question. This presents a significant opportunity and potential for banks to engage with their clients, sharing insights and ultimately supporting them with transition finance. However, there are three key challenges in assessing company transition plans, which we have been helping our banking clients to solve. Firstly, despite many frameworks existing, there isn't currently a universal agreed approach to assessing eligibility for sustainable finance products or the credibility of transition plans. This in turn creates broad confusion and mixed messages to customers when banks are having to make financing decisions. Having a clear assessment framework and strategy to achieving a bank's net zero target is a critical success factor for the bank. Secondly, there are many nuances between sectors that increase the complexity of transition plan assessments. These nuances can be addressed and better financing decisions made when teams can access the tools and data they need and are given sector-specific training and insights that help them to build their own credibility when speaking to their clients. Without a deeper understanding of sector-specific considerations and good climate risk knowledge, your people won't be able to successfully engage with their clients, limiting their ability to identify commercial opportunities while trying to simultaneously meet your net zero ambitions. Finally, financial institutions risk making ill-informed financing decisions, which can pose significant risk to the organisation, particularly given the rise in scrutiny and increased greenwashing allegations. This requires net zero targets to be embedded across the entire organisation, not just specific sectors or teams, with ambitions set from the very top of the organisation. In order for banks to reach net zero targets and benefit from the significant sustainable financing opportunities that are available, they will need to move fast to differentiate themselves in this very competitive market. They will need to start with upskilling their front office relationship bankers with sector-specific training and guidelines, which is practical and impactful for building capabilities in the front line. Only then will they be able to deliver impactful change and evidence the credibility of their net zero targets.